All right, we're going to get rolling.
They helped create an economy that was completely addicted to cheap money.
You need to buy savings bonds or something. You need to be way, way, way out of this space.
I subscribe to Miss Piggy's rule of money management. Always manage to have more money, you know what I mean?
It wasn't but 2 years ago that everybody was saying China's economy was going to be bigger than that of the United States. It's gone in the exact opposite direction.
So we're going to jump right in.
Welcome to This Week in Mining, where we talk about how to make money in the metals and mining market. I'm joined today by Tavi Costa and Ivan Bebek. Pleasure to have both of these gentlemen joining me today. And I'm really excited because there's a handful of directions I want to take this conversation. Here's where I want to start, though, Tavi. You're a huge Twitter personality, among many other things, but one of my favorite follows. And your tweet today was a chart of gold junior miners. The caption was most intriguing to me. It said, "Ladies and gentlemen, this is it." It was like a start your engines sentiment on this tweet. So if you could unpack what you're seeing right now in the junior market, how you're feeling, are you excited? And if so, what are you seeing?
Just a catchy post. No, I'm joking. This is, I think, to me, there's so many ramifications of a bull market in the gold space that I think we're still in the process of sort of unleashing. And one of them is the mining industry that, you think about how much skepticism has been in this space. And now we're starting to see people change their opinions. And there are reasons behind why the skepticism too. From a general investor, there has been so much over conservatism in terms of the estimates of most of these mining operations in terms of how much money they're going to make. If you're in the process of buying mines and all sorts of things, you will figure out that some of these considerations are overly conservative, but that's just part of the nature of where we are in the cycle as well. And it is interesting. There's so many different signs of things. I mean, we're seeing M&A is starting to, a lot of companies are starting to engage with, especially the smaller businesses. We're seeing this need for the replenish process of most of the reserves of most of the major companies is starting to really not only challenge them, but really force them to look for opportunities elsewhere. And we're seeing this firsthand in our own portfolio of companies, but also even working with folks in general of seeing this engagement level completely shifting from prior years. But I think it's all predicated on your views about gold. When gold starts moving, other metals will probably start following the same way. We all try to be cute and think about what commodity will move the most. But the truth is all those commodities sort of follow the same pattern. And you really need to make sure you are in identifying that you are in a secular bull market for the metal. And if that's the case, a lot of things will check. Emerging markets could do very well in this environment. You can see resource companies following along. But the reason why I get so focused in the mining space is because it's one of the oldest industries, if not the oldest in history. And at the same time, it went from being one of the most relevant things for society to now becoming essentially something that is almost insignificant. And I couldn't disagree more. And I'm referring this insignificance from a capital standpoint, not really from a significance from what we, as a critical need for society and for the global economy to continue to run itself. And so all these things are starting to come to fruition. Just a data point, the US, the mining industry in terms of fixed investment used to be close to 30% of GDP back in the 60s. That's not too long ago. And today it's actually 0.3% of GDP. And so, this is not talking about the weights in markets. I'm just referring to all the spending that goes to mining relative to the size of the economy. And so I do think that these are going to be changes. They're probably going to see flows of capital coming back to this industry, especially as we see and really understand that this is as critical as it gets, especially in the world of deglobalization trends intensifying. And to me, the repricing of most of these businesses are still to happen. And as we see that with the M&A and all sorts of things and the fundamental improvement of these companies, the change and the returns that are possible here, in my view, are things that we just haven't seen in many decades. And so hence why I believe the sole focus in this part of the market is just absolutely critical at this point.
That's an incredible stat. I got to pull on that for a second. So if I heard you correctly, in the 1960s, call it mining and probably mining related services accounted for about 30% of United States GDP. Today, that accounts for about 0.3%. Did I capture that correctly?
Yeah. And by the way, I'm not here to say we're going to go back to 30%, but what if we go back to 1%? It's just, those are big changes. And so if you're an investor, you're always thinking about the rate of change of things, not just from a sentiment. I mean, imagine how many people that have been beating on this dead horse saying this industry doesn't make any money, it only bleeds capital. I don't understand why anybody would focus on this. And then all of a sudden you start seeing all these technical charts showing, which was this chart that you're referring to, the post on Twitter, a technical chart showing a major breakout from many, many years, a resistance that we hit it so many times and markets have sold off, and now we broke out of it. And everybody is still off in terms of positioning. So, I think this is an ability of understanding this market like Ivan and very few others, not many others, very few others will be in very high demand in my view.
Now, you mentioned public sentiment and public opinion. It makes me think when you pull up that 1960s stat, and I just think about more near term, where has public sentiment been looking? And it's definitely not been the materials sector. It's been anything, tech and fancy, right? Which I think for good reason. But when you have such a small number of innovation companies dominate so much of the capital markets, the secondary effect of that is that the materials sector gets starved of capital. Projects don't get financed, new supply doesn't come on market, which limits our ability to actually build the innovative future that these tech companies promise. If we don't have the ingredients to build the energy infrastructure, the copper for the cars, the silver for the solar, all that stuff, we need it. Now, you also mentioned this I found interesting, conservative forecasts from majors are tempering enthusiasm. Did I capture that correctly? And if I did, Tavi, why do you think majors have been so conservative with their forecasts?
I think it's a function of a lot of things. Regulation is one of them. Number two is just the fact that they have to be conservative after missing in so many estimates and showing the market one plan and having to go with another plan later on. And I believe that's just a function of again a very highly depressed industry. But just thinking about some of these projects that are being sold today, and I'm not even talking about public markets, just looking at cash flowing vehicles out there that are privately owned, that are being shopped around. You look at some of these assumptions. Their assumptions that I see are huge inflation on cost, huge. And then you looked at the assumptions on metal prices, it's deflationary. And I don't know what world, both of you think we're going to be in, but I think it's hard to think of a world where we're going to see inflation in cost that is not accompanied by much higher metal prices as well. And so if something is being sold under those considerations, I think you have to sort of take advantage of it. And I always think about these things because we all want to be great negotiators and try to buy things as cheap as we can. But when the market is negotiating for you already, it doesn't really matter if you're paying 10, 15, 20, 30% premium on, what you really think that is worth today. Because, if you throw prices of gold and, over 3,000 and so forth, I mean, it can change the dynamic of a business in a very significant manner. And so, that's the mindset that at least I'm trying to take. And I think most people there are still in this industry have to be taking that approach because otherwise they would have been gone. So, you have to be very persistent and have conviction. And a phrase that I like to say usually is, you can steal somebody else's thesis, but you will never be able to steal their conviction. And this is a big distinction when it comes to making money, because acting on, when a thesis is challenged, every thesis will be challenged. I don't care what it is. and being able to act on it with conviction, meaning buying something when it goes lower, is something that changes as well your performance over long periods of times. And so being able to do that over and over again only comes with conviction. And so if you don't have that conviction, when you're in that position, you're basically a weak hand. And so you got to avoid being in that position by having conviction. And by having conviction, you need to do your own analysis. That's why it's so important to do your own homework on things.
You can borrow somebody's thesis, but you can't borrow their conviction. I like that. Ivan, I want to throw it over to you. You're one of the entrepreneurs in the business that I've learned a tremendous amount from. And what I love about your style is that you're one of the hardest working guys in the business in good markets and bad. And I think that's a nice segue from Tavi's conviction statements, because it takes a lot of conviction to stay grinding the way you do when the market's not throwing you any favors back, right? But what are you seeing today? And any comments you have on Tavi's statements so far?
Yeah, no, I'm a huge fan of Tavi's perspectives, and I saw that chart that he posted today as well. Thank you, Tavi, for doing that. I don't have the time to do the work, and you do phenomenal work, but on that chart, a lot of people will look at it. Is this another wave before the bigger market starts or not? But what I like about your chart is when you look at the time frame that exists in the gradual increase, it's not a sudden spike and a turn. It's a gradual climb, and you could draw a nice chart if you started after the correction. But having seen both bull and bear markets, there's a couple things. I see, tremendous amount of opportunity, which people hate because it's been so opportunistic for the last 3 years. It's actually created a lot of negativity amongst shareholders with the lack of returns. The speculators are gone in a sector that's struggling to go find things, and at the same point, people are forgetting if you find something, you can make a lot of money on it, as the Lundin family has with Filo mining. That hole took 23 years to drill, but they went from $3. I think they were bought at $35 probably within a year or 18 months since that hole was drilled. That will help the market. But what I like most about a comment Tavi made was the consolidation that's starting to happen. And the comment you made about the majors putting out conservative forecasts. We had to contrast as a sector. We were bloated with the 2011-12 peak. There was so much demand because metal prices run, but not enough people, not enough drills. And I remember vividly trying to get a drill to our project in Mexico, and it took 6 months to get a really, inadequate drill there. And that inflation that we do amongst ourselves, that bottleneck is real. But now we have a huge amount of infrastructure available because we built out, but everybody's cut back their spending. Where we sit today and where I'm at is as I said earlier, I'm a visionary. I'm looking at tomorrow and what might happen next. And there's a couple really, really glaring points to me. Number one, I don't think there's even a remote debate about where the dollar may go and interest rates will go over time here. And we all know that's going to be extremely positive for hard assets such as metals. That's going to help. Number two, the stat I didn't know before was the 0.3%, 30% invested. And if you look at what happened from 1960 to 1980 and how much development occurred in infrastructure globally, but you also have to consider now we have double the population since back then. And I talk about this quite a bit because that's more double the demand for metals. And we're flipping on the electrification switch at the same time, which is a new paradigm. It used to be Dr. Copper with the economy. They're not going to slow down the electrification. That is the cleaner future. We're all working towards that. And that draws on several base metals and various metals that are going to support that. On the gold side of things, though, it's always been the most emotional metal. It's been the benchmark. I found it has always led the market. Although in May, we saw this $5 copper price come out, and I raised the incredible financing at the time, and I saw the ease in the copper bull, which is the most impressive in my view. But the gold investor is the one that usually leads the charge, and obviously silver has its place to trump all in equities. It performs the best. Those three metals make the most sense to me, and as an entrepreneur, you could have done a lot of great things. You might have a world-class project to drill. Being financed and having the perseverance to get through has been the most rewarding return I could give to investors. And what I mean by that is it's so easy to quit. There's so many people that are running out of the gas, they're running out of the energy. And for me on my end, in the past successes I've had, they've always come from that work ethic, sticking through, grinding out through good and bad, and coming out the other side. The luxury that I've had as an entrepreneur in the business is I've been able to monetize things well into the dollars, during the right points of cycle. But the cycle will always be bigger than us. And if you can take a step back today and look at the sector for what it is and where it might go, versus the pain of the last 3 years, it is much different, than the last 3 years ago. The factor that really threw everyone through a tailspin was COVID. And the money printing, that injection of capital, record in history. And then we went to a point of inflationary economy, and we had to skyrocket interest rates, which took the bid out even further. And competing sectors such as tech, the Dow, and the US economy and real estate, they thrived on that. So if you rewound the tape and said, how do you think it's going to go if all of these things take place? Choppy markets, election year, injection of capital, running real estate, record consumer debt, or increased consumer spending, you get to where we are today. But the good news is we're at the end of that whole saga, in my view. And I think Tavi's chart is very, very representative of what could happen next year in the metal sector. I don't expect it to be a line and go up straight overnight, but I do expect to get completely caught off guard, even though I am uncomfortably long. And my thing is, it's way harder to find the metal or the teams that can monetize the success than it is to find the money. The money will come if the project's there, but these projects that we go after are very difficult. The entire list of companies that are worth investing into, another comment that Tavi made, it's very small. There's a very small door for a lot of money that's going to come in. And even if you go from 0.3 to 1%, this market's going to swell so aggressively, and it's going to be such a incredibly inflationary market. Now it starts at the top. You see M&A consolidation at the end of the market and at the beginning of the market. I personally think there's a lot more consolidation on the smaller side of companies. I think a lot of juniors that are stuck, that can't get through, they're going to get rolled up into companies that can. I think that's time for that. That's your next big wave. But at the same time, if somebody makes a discovery today in gold, copper, or silver of consequence, I think you get paid 5 or 10 times as much as you would have a year ago because of the state of where we're going. And the last point I'll make is, who's ready, who's drilling, or who's ready to go make that discovery today? A lot of companies don't have the money to drill. A lot of people are sitting and waiting and letting it come to them. Very few are going out there, which makes that selection of things worth buying even smaller. The one thing I love most about this sector is it is cyclical. It does repeat. I don't like predicting cycles. I rely on people like Tavi and others to do that. But I will say that as hard as it's been to get here, you can make up a lot of lost time with modest success and exploration at a time where the world needs the metal more than it ever has before. And so that's my perspective on all of that. As an investor, I am exhausted. That would be the best way to describe it, but I'm extremely bullish, and I'm going to continue that annoying optimism because it's starting to happen in the gold price. I'm seeing it globally through various conversations. I'm seeing money flow back in. Agnico Eagle, Newmont, the big companies are reacting, BHP, Tech. There's a lot of money that's starting to be made at the top of the sector. So it is happening the way it should. It's happening gradually, not suddenly. There isn't much time left in my view. I do think there's a lot of urgency to buy other companies or acquire other assets or to build a big equity position. And the last point I'll make is you take a junior that has a big swing on an asset and, it trades at a discount. It's one hole that took Philo from $3 to $25 per share, one hole in about a month of trading. And you try and catch that as a buyer. And so, the argument would have been a few years ago, yeah, but when's that hole going to happen? And I have time and the markets aren't there yet. Yeah, that's a hard hole to drill. But the market today going forward is some places there's a lot of holes being drilled and that could happen at any moment. And it's really tough to buy big positions and to be positioned comfortably in that. Yes, your timing's better today than yesterday. The share price of entry does not matter to me as much as where it's going. And I think now we're going to a much better place if those discoveries are made.
You said this sector is cyclical. It does repeat. Both of you guys have spoken to the fundamentals in the business. You both actually spoken to the consolidation and M&A activity you're seeing at the top of the market. And then you said, Ivan, when this market turns, I expect to be caught off guard. And it made me think of right before we hit record, you were recapping a conversation with Frank Justra describing gold investors like a school of fish, in that it's hard to predict the direction of a school of fish, but when they turn real fast, right? And it's impossible to time that, right? You've been through a few cycles right now. So I'd love you just to expand actually on that analogy, because I think they're useful analogies for audiences like mine. Why does that analogy ring true when it comes to gold investors?
Sure. So we saw it a few times in the few windows we've had We saw it in my other company, Oren, where I spun companies out of. We went from $1.60 to $3.50 in 1 month when the COVID hit and they started to print the money after the correction. That's a very, very fast return without a single fundamental press release that changed anything in the company. And that's what I'm talking about. It's happened 3 or 4 times since. I'm looking at investments right now in all parts, my own companies, but gold investments and stocks that are somewhat illiquid, juniors. And I'm just imagining gold crossing to 2,700 on the rate cut. And that's what I feel could happen, 26, 2,700. I'm waiting for that school of fish moment where all the sellers are on strike and nobody wants to sell anymore. They turn into buyers. And that's what happens, Jay, is a seller becomes a buyer in the same hour that gold crosses that magic number, or copper or silver, whatever it may be. And it's fascinating to see that. I think through my time, I've learned less positions and bigger ones are better than more positions. The rebuttal on that comment is what everybody needs money. Everybody needs capital. And you're absolutely right. They do. But the amount of capital that's going to come in, there won't be enough for everyone to have a big position in the deal. So that's my favorite part of the sector, is when that school of fish turns on a dime and goes the other way. And that's where you go from being anxiously worried about the time it's taken to gradual to be, do I own enough shares? Did I buy enough? I feel like I'm light on this position. And that's coming, Jay. And I can't predict the day. I can say the events that could affect it are happening. Wars can do it. Economic policy shifts can do it, to easing. Rate cuts can do it. We've all seen, or I've seen in the .com era with emergency rate cuts, I saw that whole market turn around. And I remember very inexplicable days where Placer Dome was an old company at the time. It went from $12 to $18 in 3 days. That was the 3-day trade when gold spiked over $300 an ounce back then, from $280 an ounce. And I'm saying that unpredictability is coming, and then it's going to come down to the quality of what these companies have. So yeah, I love that part. It's coming here. It's going to surprise us all. And that feeling that you get in your chest when gold is running and breaking out, and everyone has that. It's gold fever. You know, that is something so compelling about gold as an investment. I've always felt underexposed, even though I've really bought a lot in my companies when copper was running or gold. How do I get more shares? And that's going to be felt market wide. And then you bring in the new people that have not bought the sector. They know it's there. They leave it in the back drawer. I can buy it. It's suffering. It's negative. And you bring in those people, and the capital this time is dramatically bigger than it's ever been before. And the finding of the metals is harder than it's ever been before. So yeah, I'm going to have to go back to comments Rick Rule made back in early 2000s when I met him about the super cycle and 21-year bull market, which we're entering now, this final 7-year phase that he had mentioned to me in my early 20s. And now I can see the shaping of that market. I can see the shaping of demand, lack of supply, and a sector which is broken with so many people leaving it or drowning in it, waiting for it, and no one's ready for it. So that's where I think things get interesting.
I love that. You reminded me just then of a conversation I had with a mutual friend of ours, Marion Katusa, during the 2021 gold market rally. And a lot of people were saying this is heating up really fast. If the gold industry were a baseball game, what inning would we be in? And I put that question to Marion once, and he said, look, if the gold industry were a baseball game, the game hasn't even started yet. We're not even in the majors yet. This is nothing compared to what's to come. Okay, look, you touched on rate cuts and the potential impact on gold price. Tavi, I want to pass it back to you. I think Jay Powell is sitting in Jackson Hole right now for their annual meeting. Walk me through, do you have any expectations on rate cuts? Is it a foregone conclusion? What might occur? What's catching your attention?
I was recently at a very interesting meeting with a bunch of macro guys in Vail, actually, with one of the guys was on Market Wizards. If you guys have read that book, it's a great book with a bunch of interviews of famous investors. And we were talking about this shift on, especially from the Federal Reserve and monetary authorities, concern about the fiscal issue. I don't think they have really been speaking out about this problem outside of a few comments, but I think this is obviously becoming a larger and larger concern. What really is an issue is this obsession with inflation and labor markets, which I blame myself for trying to understand those markets as well. But it's sort of useless because at the end of the day, if the Fed, or I should say the government, cannot service its debt, it's going to start to become a real problem. And looking back in history, two and a half centuries of actual data, you can see that we're actually sitting at about almost 4% of GDP in terms of interest payment to service the debt. Why does that matter? It's a very, I guess, unpopular opinion about this whole issue on the macro side is that the debt problem in the U.S. is actually very manageable, believe it or not. We've seen, imbalances that gotten a lot worse. What is not manageable is the interest payment relative to GDP. That's becoming a problem. We're actually hitting in a level that early in the 19th century, the British Empire actually had problems with that. And once you get to that level where interest payments, it starts to really eat into your GDP growth, and you have to grow the economy to a certain degree, right now about close to 50% just to pay down the debt, then it starts to really become a problem. And so at that time, they had to recapitalize their debt or restructure the debt, essentially. So what was a shorter term duration ended up having to be restructured on the long term. You tend to see some sort of yield curve control or changes in the deficit situation, which is probably what monetary authorities are going to be going after, trying to change things to be maybe in a primary budget surplus, which emerging markets know this term very well, primary budgets. Developed economies don't know about this because they haven't dealt with this issue in a very long time. But that's basically just taking what you spend on the fiscal side and excluding what you spend on interest payments and making sure that portion that excludes the interest payments is actually on the surplus. If you're running that, that's what they did in the 1940s. And we've seen examples of this throughout history. Now, in a world like today, here in the US, would be unthinkable doing something along those lines. You have military spending that still needs to probably go higher. You've got infrastructure spending that needs to go higher because of onshoring, because of electrification and all sorts of things. You got AI and the need for data centers and all sorts of investments that still need to come online. And so it's hard to believe we're going to be able to adjust the primary. But so what is the ultimate goal here to fix this unsustainable problem of to service the debt? It comes down to the path of least resistance, which is some sort of yield curve control. And I don't know if it's going to be an actual yield curve control, but some sort of mechanism that allows you to suppress interest rates. And that is exactly what creates a supercharged environment for hard assets. And so if you know that in the next 5 to 10 years, there's going to be some changes in terms of policies to address the problem. In fact, I was referring to the British Empire back in those days because that was exactly, after those issues, after we reached about 3 to 4% range, it was exactly when they started to restructure the debt. So we are exactly where we are. And if we compare this with other economies, so if we just looked at the US versus Japan or versus Europe or any other economy, you're going to find that majority of those countries are running their debt service ratio, I should say, or interest payment relative to GDP at lower than 1%. So, the readjustment that is inconsistent with the U.S. policy versus other places in the world, in my view, will have a major impact on the dollar. So I used to be of the view that the dollar was, the cleanest of all dirty shirts, but I'm changing my opinion in the last, call it 4 months, 3 months after this research, because I do think that the BOJ has even a better ability to raise rates than the Fed. And the Fed is going to be in a very difficult situation in the next 12 months, having to justify why they're going to be cutting rates for inflationary or labor market reasons, when actually the real reason is just because they can't service the debt in the long term. So this is going to be a real impact of the dollar relative to other, and this is not priced in at all. If you look at volatility for FX, especially across emerging markets, that could potentially do much better as a currency versus the US dollar. These are going to be very meaningful changes in FX market. I think we're going to be in a world where other currencies can actually outperform the dollar in a significant way. Now, some people will say, "Well, are you saying this is the end of the reserve status?" And that's not my point either. I'm just talking about the next 3 to 5 years. What I think that will likely occur with the FX market, and I think that those are going to be very significant changes here. Very close in 12 months or so.
So while a lot of people obsess over debt to GDP, you may make the argument that that's not as significant as interest payment to GDP. And our interest payment to GDP in the United States is around like 3.5% right now, but on pace to hit 4 within 10 years. And that is the range where the British Empire began to get in serious trouble. Did I capture that correctly?
Wait, on pace, we're going to be at 5 in 2 years, right? But if you look at
5%.
OECD,
Okay.
this is no issues ahead, no recessions, and everything keeps the way it's moving, which I highly doubt that's going to be the case. We could easily be at 7, in 5 years. So yeah, just to give you a sense, that range of 3 to 4% was when they had to start, really thinking about what do we do here? Do we need to restructure the debt? And that's what they did at that time. Nowadays there is a possibility for that as well. I just think that if you look at Japan is not a great example, although I love Japan as an example in terms of the debt, the magnitude of the debt problem. They're just not the reserve currency. But if you look back in history, other reserve currencies, they exhaustively went above the 200% of debt to GDP in terms of the government debt. Mm-hmm. And so the U.S. has room for that. As long as they reduce the cost to service it, we can do that. And we're probably going to do that, in my opinion. It wouldn't surprise me if in 5 years or so we're at 200%.
Sure.
But we need to adjust the interest payment side of it. And that's, that only comes through 3 ways. Restructuring the debt. You can also do the primary budget surplus, which I think it's, ultimately we're probably going to go there too, but not at the medium term. And the third one is the yield curve suppression, which, if you're a resource investor, that's the type of supercharged environment you're praying for. And so, to me, this is why it gets so exciting.
Now, Tavi, I just have to ask, where do you land when you hear the de-dollarization conversations, when you hear people get pretty hyperbolic about Project Enbridge, BRICS currencies, new rails for non-US dollar transactions on a global? Do you put much emphasis on that, or where does your mind go when you end up in one of those conversations? Inevitably, it must happen to you.
No, they do, and I think unfortunately is not as relevant from an investment standpoint. Although, to me, I'm not sure what the replacement will look like. Gold in a multipolar world is probably the answer for all this, and gold is certainly making a comeback in terms of central bank assets relative to relative to balance sheet assets as well. And so those are important changes already unfolding. And I don't really have a strong view about if we're gonna, I don't think you really need to have a strong view for the next 10 years if we're gonna lose the reserve status. I do think this idea of economic exceptionalism coming from the U.S. is not necessarily true. It's really happening on the back of fiscal exceptionalism. And I'll give you an example. Since the global financial crisis, if you looked at how much fiscal spending every country in the world has spent relative to GDP, the U.S. in average has spent over about 8% of GDP every year. Relative to, let's say, any other country, Japan is the closest. I think it's about 5%, but majority of the spending from their side is all entitlement, which in the U.S. is actually a lot more pro-growth spending, believe it or not. And so that's why you tend to see much stronger. There's no kidding. We're seeing this differential valuation of U.S. companies out, versus a very similar business in Brazil or in Peru or, you name it. And I just think that that's unsustainable. I think that differential will not be the case 10 years from now. In other words, we tend to see every decade this leadership of the U.S. versus the rest of the world shift. And early 2000s, we saw the rest of the world take the leadership, and the U.S. actually, sort of went through almost a stagnation period during that time. And I think that's very, very possible again today. And so I'd much rather deploy my capital into emerging markets than in the U.S. We've been saying all sorts of quotes here. So another quote from Sam Zell, who passed away recently, one of the smartest guys I ever met. And one time he said, great money is made when there's lack of capital interest. And that's like the opposite of the definition of what's happening with technology today. So if you're of that view, and even if you go bigger with the US as well, there's abundance of capital here. So that's probably going to be where the opportunities are in other places. And so this is, why I think emerging markets will probably take the lead here very soon.
Interesting. Similar question I want to pass to you, Ivan. How much emphasis do you put on the de-dollarization conversation, on the future of reserve or trade currency conversation? Or, do you just keep your head down and say, look, it's my job to build value for shareholders. I build companies. That's what I do. How do you?
Yeah, so there is a fact. Yeah, there's definitely a factor. It's a great question. First off, I rely on smart people to do smart things. I don't try to outsmart every market. I don't have enough hours in the day to learn as much as Tavi knows and others. And I will say this, though. I did pay attention to record purchases of gold by central banks. And I'm surprised more people haven't paid attention to that. And one thing I've learned in my career, I'm a big U.S. investor, friend of mine, mentor of mine, and he told me the banks are never wrong in the sense of certain moves they make. And you have to watch it because they do control policy. They do control that. They can see the debt. They can see the cash better than anyone else. So all I go to bed with as an entrepreneur on that side, not to get too specific into it and rely on others, is record buying of gold by central banks, which has certainly set the stage. I think the second part is I have to time cycles and time waves in the market, which is much harder than timing cycles. And that's how I try to finance in the perfect windows. But the most important thing for me is finding something big enough and rich enough, like we saw in Philo or other companies, something big enough and rich enough that would make money in any market. And if you're looking for that asset, it really takes the market and the cycle out of the equation. And the best part about that comment is the market we're headed towards, regardless of metal prices. There's shortage of supply almost in every factor. There's less people looking. Everything's behind schedule, and the world is growing at double the population, double the rate, or I don't know the exact, increase in rate over the last 30, 40 years. But things are growing. There's a problem coming, a big one. And this market will go parabolically in the opposite direction as we've talked about here. So I keep it high level. I watch the central banks when they were selling gold and gold was being sold, gold equities were peaking as well. And that's something to look back to 2011, the last peak in the bull market. So when they get to selling, I would expect the frothiness in the prices of a lot of the equities. And it's interesting how they misalign and prices are going up, gold is coming down, and central banks are selling gold. But that's kind of the state if I was to look at the US tech market and the Dow and all of the above. The one comment I have towards that market, which gives me comfort, is how much higher can it go? And how do you sustain the curve, the steep curve since COVID of the capital injection? How do you sustain that trajectory? We did not double the population in the US. We did not increase the economy to that extent. We've already had the big move, whereas in our sector, we haven't had any move yet. I like your comment about we're not even in the first inning of where this thing could go. So I think looking at some basic macro pictures, it really gives me comfort. But I try to put on the blinders, as you said, and spend less in bad times, raise more in good times, and just, again, keep the eye on the big prize that wins in all markets.
Now, we spent the majority of this conversation talking about mainly gold. I want to pivot to copper for a minute, Ivan, and maybe I'll stick with you here. So back in April, we saw BHP's attempted merger with Anglo. Essentially, they would buy up Anglo's production. That's one way for a company like BHP to increase their value in the coming commodity market. More recently, they purchased Philo in combination with Lundin. So this was different, right? They weren't buying existing production. They were investing in future production, which is in reality what the world actually needs. It's a longer term play for BHP. Can you break down what we saw there for anybody who probably wasn't as close to that news flow as yourself? And what's your take in terms of copper sentiment and fundamentals?
Well, I think you've answered your own question in a sense. When the biggest miner in the world, BHP, I think they're one or two, goes to buy another major for its copper assets, you have to pay attention. Why is that happening? Why would they make the move? And then secondly, when you look at Philo, they bought an exploration stage predominantly copper asset. And what more would you want as a signal that exploration copper companies are giving when they're being purchased at this stage? And last point is, what's the biggest reward that's been achieved in this market in the last 2 years? Philo, a copper asset being bought by BHP. $3 to $33 or $35. I don't have the exact specifics of $4.5 billion takeover. If you keep it simple and you take those three factors and ask the rhetorical question, is the copper market a real serious copper market? Yes or no? And then look over at Ivanhoe Mines or Robert Friedland. And I follow him. I followed him before I got in the business. That was my first learning of the sector was him. And the first stock I ever bought was Ivanhoe Mines in 1995. And when I was in high school, I got in a car accident and my dad knew Friedland. And so he said, there's this guy, he's an incredible entrepreneur. And I bought it. It took 17 years to go public, which is a time that frustrated many people came and left, but now it's a double-digit share price. It's been an incredible performer, but it's the long game. Copper is the long game because it takes a long time to bring these things online when you find them. And as much as you want to accelerate permits, you can't accelerate social. So these things take time. And in our situation, we spent a decade on social, getting through to get permits. That's time spent. But these things in referring to major opportunities to find big mines that could reward like Philo did. They take a lot of time, and that's the one thing you can't buy, and you have to earn, as you run these companies. So my view is the three basic factors have taken place. You're seeing consolidation at the largest companies in the world. You're seeing moves in the exploration sector, not just on advanced assets. And I think it's a race for copper because that is the future, real new oil. As I said this about 5 years ago and I got critiqued for it, but eventually I think we're running on a copper electrical society. That's where we're trying to get to. But we're going to have to go at the pace that the metal can be found and mined at.
Interesting. Okay. Now, two of your previous companies, Caden Resources, the gold company, you sold that to Agnico Eagle for $205 million. Prior to that, Keegan Resources became a mine. Your company today, Copernico, now you're in the copper sector. So I'd love you to take a minute and walk my audience through what you're building in South America, Ivan.
Sure. So I entered this sector as a contrarian in 1999, and copper was around 60 cents a pound. I worked with the guy that found 6 major mines around the world, Dr. Roman Shklenka, and they were all gold mines. I was a gold bug, but a copper bull, and we first took a stab at copper. So I learned copper back when it was so cheap. Move ahead, did a few gold companies. I absolutely love gold. I'm a massive gold bug. I see its place and I've made most of my money off of gold. But I got onto this copper opportunity in 2015. And the first hallmark of the opportunity was scale and opportunity for grade. And it quickly drew an analog to a large mine called Las Bambas, which sold for $7 billion in 2013. This was in a fairly challenging area in southern Peru where several other major mines occur. And we knew that it was going to be an effort to get into this area. And we were well on our way until we hit COVID. We had a break, but we had done all the revealing efforts. There's some drill holes that were drilled by an iron ore company to see the copper subsurface. We saw hundreds of meters of around 0.5% on surface. So we saw the third dimension existing there for the scale of the opportunity. We finally got access and we got drill permits in April of this year. And we were able to go out and we were able to identify or be able to drill 7 kilometers, which is about 40% of the existing targets. We're not even maybe in the best part of the system. We don't know yet, but we have a very big target-rich pipeline. We have infrastructure at site. There's power lines over the property. There's 4 water sources nearby. That gives us a chance to be very profitable in what we find. But the grade of the previous drill holes and some of the trenches on surface is averaging about 0.5%. So for me, this is a project that has a very rich pipeline that would take 2 to 3 years not to find a major copper opportunity. It has a very direct analog to multiple major mines, one most notably being Las Bambas. And it's got the start of a discovery with some historical holes. So it's more of an expanding discovery story. And it's going to be one of the most exciting things I've drilled in my career, which matches perfectly with the outlook on copper. I'd say if you look at the math and how it's gone so far, it took me 9 years to get a drill permit on it. And it took me 2 weeks to raise $19 million, where Teck bought 9.9% of the company. And if you can take that equation here and think about what we said earlier in the interview, the asset is the hard part, not the money, even though it's hard to get money. And so what I wanted to align myself with and our investors with is an opportunity to find multiple major copper deposits at a time where they're the most valued. And I think we have the perfect, or I believe strongly we have the perfect storm in terms of the environment. And we're on this 2.5 holes into the program and we're learning a lot as we go. But this will be something that gets drilled for the next 24 months. We're funded into 2026. So it has protection from downside, but it has the scale of targets that could make a world-class top 20 mine in the world. And that's what we're going to be exploring for. So that's a snapshot of the company. We're currently drilling And, we just started trading on the Toronto Stock Exchange under COPR. Sorry for the ad here, but that's the symbol. We don't have our US symbol yet, but the market's been quite patient with us because we were a spin out 3 years ago from a company called Orin Resources. But in September, we're back on the road. We're out of the summer doldrums, and we should have results starting to come out late September going into October and see if we have, the worth weight kind of experience. And I love Discovery. Discovery is where I've made all the money in my career. Keegan from 10 cents to $9 finding a 5 million ounce gold mine. Caden was bought at $3.60 per share. Agnico Eagle doubled after they bought us 14 months later. That's the kind of return you get in Discovery. And that's why I chase Discovery. Finding something new that nobody found before is the number one most rewarding way to get rewarded. It comes with a level of risk, though. That's not for everybody. And I'll caution people, you put in money you can afford to lose because the odds are against us. However, to mitigate those odds, you do it with a lot of targets, a very big target or a big system, and you do it with really good financial position in terms of treasury. And we've done all three on Copernicus. So extremely excited to be drilling and pointing out that being in the position to drill today, as I think the copper market is starting to really pick up here in the next 12 to 18 months, I don't think timing could have been better for us. It's perfect timing that took 9 years to plan or planned us. And that's where we sit right now.
So drill permits in April, you began by exploring 40% of the existing targets, put 19 million in the treasury. That gives you a 26-month runway of exploration, of which targets you've got plenty. You said it could take 2 to 3 years to determine there isn't something here. Right? It would take 2 to 3 years to determine there isn't something here, correct?
Yeah, so into 2026 treasury, just to be clear,
okay.
30 holes are paid for. We have capital into March of 26. We can use more capital to drill more holes. And, for having success, obviously, we'll take more capital as things go, but extremely well funded. And and every hole we drill could be something substantial like the last hole at Philo that took it from, A to all the way to Z, right? And I just want to make that point very clear. The business that we're in is we're one drill hole away because of the advertising from the surface work, the historical work, the scale of the system. One hole could really unleash that potential. And again, catch a lot of people on the sidelines, and the people who own it are not going to want to sell if they see that hole come up. And the people who want to buy it are going to have a tough time buying it. So this is why I like risk and I buy early, is because you don't know when that hole is going to come. And I've seen when they happen before. I saw it in Philo. I saw it in Aurelian. Aurelian went from 20 cents to $44 in 6 months on a gold discovery in Ecuador at the right time of the gold market. I've seen these things kind of progress so quickly. And the problem buying those things is not that you can't buy them. It's that, is it safe to buy it after it's gone from pennies into the dollars at $2 or $3? That's the hard decision to make. Is this real or not? Because the risk goes up a lot as it goes. So, my timing has always been early. I'd rather be early than late. And I want that maximum upside for my shareholders. So the current shareholders that are there, they're all seeing the opportunity as high risk. And we're mitigated again because of the multiple targets we have, and that additional targets we're going to get permitted to drill as we're exploring the first parts of the system.
The only thing I built on there is when you said the asset is the hard part, not the money. And I think it's great to hear you say that. And I find myself wondering, but how much of that is because you've already put the puck in the net twice with previous companies? Because so frequently, I caution my audience. I'm like, when it comes to these early stage companies, the most important resource is cash. So many companies run out of cash and are unable to finance. Now, there's a select few that are able to raise money. You're one of them. You're one of the entrepreneurs who's proven you can deliver. So you can raise cash in good markets and bad. And some entrepreneurs can, but many can't, right? And I tell those, if you're looking at those companies, like, pay attention to the cash over everything else, because if the money stops, everything stops.
So that brings a great topic, and that's people, right? Obviously, I've been very fortunate to have been through some great successes. We have some tremendous supporters that have recognized it. Some have realized those successes previously, but having the asset, getting the cash. But one other thing that happened with this company, which is really, really fascinating for me, was I got to go and find some people at the top of industry, and I've got some former executives from BHP that joined the board. I now have 3 former senior execs from BHP. The most recent one, or the second to most recent one, was Keenan Jennings. He was the VP of exploration from BHP. He not only took samples on Las Bambas back in 2001 when he was with Anglo, that's our analog, but he had been to the project in 2018 alongside several other majors, and he'd been pursuing us with interest from BHP the whole time. So when he retired from BHP last year and we started to get our permits, I wanted the VP of exploration from BHP. I wanted to pick his brain and understand his approach, because that to me is a gentleman from a very senior position, the largest major in the world. And I have a great team, but I wanted to have that senior impact, especially at the board level, to be strategic. And a lady just joined us here recently, MJ McQuay. She was running $8 billion of development for BHP, 300 people. So we have that long-term thinking, and we need that now so that if we do start to find something, we can shorten timelines and create a bigger premium for shareholders. So not only did I find the asset and money, I use that and my reputation to leverage into very, very smart people. So the decisions I'm making involve senior executives from one of the largest miners in the world, which benefits all. And the last point I'll make is I'm a very large shareholder. I've got a substantial investment into the company. And if I haven't said on your show, I'm a shareholder first and a CEO second. And what does that exactly mean? It means the share price has to perform for me to make any of this thing worthwhile for me financially. And that's the alignment I've always had with shareholders. If I had more liquidity today on any companies I'm involved in, I'd be hands full of shares and buying like crazy. But obviously there's limitations to liquidity and timelines in a market that's done quite poorly for some time. But that alignment is necessary. And you talk about management teams that can get capital and do that. I've been through the formula that has created a $9 share price from 10 cents a share. I've been through the formula that has been able to sell a company to a major mining company. I've been through the formula that has been able to buy assets, take over companies, and raise almost $1 billion in my career with companies I've been involved in. I keep shaping that formula and improving it better and better and better. But the key ingredient is dedication, focus, work ethic, and surrounding yourself with a lot smarter people internally and externally, like Tavi here is a macroeconomist who I follow closely, because it's helping me time financings. And I'd be lying if I didn't thank Tavi here for when I did my May raise. I was watching all of your posts leading up into that. I was watching the market, the copper price, and it didn't give me the answer, but it gave me a bigger level of confidence, of conviction to go out and get the capital. So the trick in this business is quite simple, is you can't buy experience. Listen to people who've done it before you, work harder than anybody out there, and chase the biggest prize you can on the board to try and reward shareholders, and keep doing it if you love it as much as I do.
Ivan, Tavi, it's been a pleasure having both you guys back on the show. I love catching up with you. I think I've used up close to an hour of your time, so I'll let you go for now, but I'd love to have you back soon. Thanks again.
Thanks for having us.
All right.